Ayola, Jacinta, can I hear you? Dr. Lukman and
Good
Augusta, good
afternoon, sir.
afternoon.
Good afternoon, sir.
Uh, let's quickly discuss on the slide that we have. That will not take us much time because we are almost less rounding up. But that notwithstanding, I'm going to make provision for a comprehensive revision on some of the topics that we have treated. Look at the X-ray, we solve past questions. And some of the slides that we are unable to complete, I'm giving you my word, I've jot those topics down. We are going to revisit it next week. So by next week, since we are through with Mrs. Christina, I'm imploring us that we should utilize both morning and afternoon class. By that I mean that we should have the normal 8 to 10 lecture to cover some remaining aspects, and in the afternoon too, we do probably 1 to 3, or 1:30 to 3. So if that is okay, then we quickly look at performance evaluation. The topics or subtopics that we have here, they are not much. And they are more or less things that have been streamlined towards what the examiner is looking for. The performance evaluation is one of the core functions required by the local and international code of corporate governance. And it serves as a yardstick that is being used to measure the contribution of the board of directors. We use the performance evaluation to determine the remuneration of the directors, the associated incentives, reward, and possibly share options. The reason for the performance evaluation is that all directors appointed for the supervisory, monitoring, and other board functions are expected to perform some basic roles. All these roles and functions must be effectively executed in order to meet the shareholders' expectations and for their performance target and reward to be able to be determined. Accuracy between the executive director and non-executive director. So if the non-executive directors did not collude with the executive directors, so it will be more easier for us to measure accurately the contributions of the appointed directors to the achievement of the corporate objectives. It will be easier for us to know the value they have added to the organization. So it will be therefore appropriate to carry out a regular review to assess the board performance. So the reason why we are doing that review, I've informed you some of the reasons. And another reason is because the board of directors are accountable to the shareholders. Due to that, the interests of the shareholders have to be protected. Because they are accountable to the shareholders, there are some expectations that have to be met in terms of returns and many more. So those expectations are what we are measuring. Apart from the fact that it is very essential and significant for the owner of the business to measure the performance of the appointed directors. The Code of Corporate Governance also include in their requirements the performance of the board and its individual directors. And this performance of the board and individual directors, it was emphasized that, say, it should be reviewed regularly. So that is the reason why the performance evaluation of the board of directors is very, very essential. And the fact that the appointed directors must be accountable to the shareholders. So the chairman of the board, you have the responsibility for the performance evaluation. And the purpose of the performance evaluation review should be to ensure that, one, the board is fulfilling its role and carry out its responsibility effectively in accordance with the shareholders' expectations, the Code of Corporate Governance, and all statutory provisions. Two, it is being carried out to ensure that the board committees are also fulfilling their roles, because we have different board committees. We have nomination committees, we have remuneration committees, we have the audit committees. All these committees, they must perform their expected roles without any bias, and all these their roles must be evaluated. Three, individual directors' contributions to the governance of the company, that of the directors and the committees must be evaluated. Meaning that this number 3 is saying that both the executive directors, non-executive directors, independent senior directors, all their contributions, including all other stakeholders that either belong to the management or supervisory role, their contributions must be effectively evaluated. They must be responsible, accountable for all their performance. Another reason why we are doing performance evaluation is because the collective skill and experience of the board members should remain appropriate for the needs of the company. What is this number 4 stressing that? It's a bit technical. That number 4 is saying that the essence of the performance evaluation is to look at knowledge gap for us to determine in the report or disclosure of the board of directors and all appointed committees that did they meet up with the local or international reporting standard? Is there any areas of knowledge gap that needs to be filled? Is there any need for all these directors to be assigned or sent for training, maybe implant training or outside training? So we want to see if they still have the requisite skills, knowledge, and experience in managing and supervising the board. So that's the reason why we have to ensure that the performance evaluation of the board of directors is done periodically at pre-stated time determined by the company. So in accordance with the International Financial Reporting Council and that of Nigeria, it was stated that the strategic intent of promoting effective and efficient corporate governance sites lies in regular review of board of directors' performance. Again, the performance evaluation of directors is equally designed to improve strategic decisions of the directors and boost shareholders' confidence. How can the shareholders' confidence be boosted? Through performance evaluation. It will be boosted through the outcome of the report. When we discover in the report and the evaluation report that all the board of directors have acted solely with utmost good faith and the interests of the directors and their investment are protected. Two, the financial reporting was not manipulated. All the mandatory disclosure and at times some voluntary disclosure done by the companies are done with transparency. And the company achieved improved dividends and return on investment. Then the confidence of the shareholders and their trust in the board of directors will equally be boosted. So, therefore, the annual performance evaluation of the directors, the committee members, individual directors, and the chairman should be done by using the approved parameters and key performance indicators. And when we are doing this, it is allowed that we can benchmark. It is allowed, you can see, it is required that internal benchmarking, DEFI method, and shareholders engagement are ensured for proper performance evaluation without bias or conflicting interests. So, what are the criteria for evaluating the performance? So we can see that the criteria of performance evaluation will bring about persistent board evaluation. Two, it will promote yearly chief executive officer and the managing director performance evaluation. Three, interestingly, the performance evaluation of the executive director will promote self-evaluation, stakeholders' feedback, and external assessment. So, meaning that before the prestated time is reached, all the appointed directors and the committee members too, they had the opportunity of assessing their own performance before they are being evaluated. And at the same time, the performance evaluation brings stakeholders' feedback. This is very, very key because when we have a feedback mechanism, it will give opportunity for the directors and all the stakeholders to know the gray areas, their areas of relative weaknesses, or their areas of hidden agenda that have been identified, the areas where they perform below ebb or expectations. So the internal and external assessment of performance evaluation of directors is a catalyst for improving corporate disclosure, transparency, and improving the performance of the entire company. And this performance evaluation equally boosts the shareholders' trust and confidence and provide a positive going concern. So, what are the key things that we use to evaluate the performance of the directors? Some of the key criteria for performance evaluations are: one, strategic fit. By that strategic fit, I don't know if you understand the word strategic fit. The strategic fit means strategic alignments. That is the meaning of that strategic fit. So we are measuring it because it is very essential. The reason why we are measuring the strategic fit and we are evaluating it is that we are evaluating all the corporate strategic decisions, investment decisions, personal decisions of the director. Are they in line? Does it fit with the company vision and mission statement and all constituted code of corporate governance or regulations? Because everything that we are doing must be in line with the vision and mission statement via name, and it must be in line with statutory provisions guiding the conduct and oversight function of directors. So if the directors have done this perfectly, then we say kudos to them. So two, shareholders' engagement and information. We can evaluate that. In most of their strategic decisions, reporting, and disclosure and activities in the company, are the shareholders, the owners of the company being engaged? Are there information in form of feedback? Because up-to-date information about activities of the company has to be reported to the owners of the company. There shouldn't be information asymmetry that will bring about a wider gap, lack of information to the shareholders. So this has to be evaluated too. And this one we shows the relationship between the shareholders and the director, if it is cordial or not. So the risk management too, how has the director of the company managed risks effectively? Are they identifying, assessing, preventing risks? So is there any investment they embark upon that is above the risk appetite of the company? How was the ALAP used? As low as reasonable practice. How is it being used? Those risks that the company is supposed to avoid, the one that is supposed to transfer, the one they're supposed to reject, the one they're supposed to accept. All these things being managed very effectively. So we have to look at this. So the financial performance of the company and even the non-financial performance too has to be evaluated. Our return on investment, return on capital employed, our market share, the goodwill of the company, all those things that we have under non-financial performance too has to be looked at. The entrepreneurial leadership style and the overall governance. How effectively was this style being performed? So these are many more are the areas where we evaluate the performance of the directors, but it's not limited to this. In fact, compliance is part of it. That one is key. You can help me to judge that. If I supposed to be the number one thing I'm supposed to put there, compliance. Compliance has to be there. Compliance with laws, compliance with code of corporate governance, compliance with constitutions. Because you must not do anything that go contrary to the constitution of the country. You must not do anything that is not in line with the code of corporate governance, be it the rule base or the principle base. And at the same time, all our activities must be within the provision of the law. Any contract that is ultra via, illegal, we must not engage in it. Also, the essence of our tax evasion. All these things cause reputational damage for the company and increase the risks of doing business. So the provision of the Nigerian Code of Corporate Governance stipulates that there should be a regular meeting with shareholders and active engagement. So I've mentioned this to you. There should be a regular meeting with all the shareholders, and all the shareholders should be actively engaged. All of them should be actively engaged because they are the owners of the business. So all activities going on in the company, they must be duly informed. Apart from that, there must be a disclosure. There should be disclosure. In that disclosure, we are going to have it as a subtopic because our topic on its own is not much. The syllabus does not require much on it. But we have two types of disclosure. We have voluntary disclosure and we have mandatory disclosure. In this disclosure, we have to ensure that all those things that have been mandated to be disclosed have to be reported. We must not hide anything to the shareholders. You must comply with stipulated law on disclosure. Because under the disclosure, the voluntary disclosure that we call The voluntary disclosure are not mandated by the law, but voluntarily, some directors engage in it probably to attract new investors and to boost the trust and confidence of existing investors. But the mandatory disclosure is a must that all directors must ensure that they disclose some certain information as required by law. Some of these disclosure are these: the cash flow statement of the company must be disclosed. Cash flow statement of the company must be disclosed. The compliance rate of the company to stipulated law must be disclosed. The financial income statement, that is profit and loss statements, must be disclosed. The changes in equity statement and the report of the auditors. All these things are some of the things that have to be disclosed. So there should be transparent disclosure and discussion about the executive remuneration. The remuneration of the executive directors, their salary structure, the incentive, the share options, and other reward being given to them must commensurate with their effort and must commensurate with industrial standard. And all since all these have to be reported to. The risk management of the company has to be reported, disclosed. So these are some of the areas that we have disclosure. Don't worry, we have disclosure by very soon. We discuss on the disclosure, so you can be able to have a robust knowledge about what we call disclosure. And this disclosure comes up very well in exam. You might be required to discuss on your understanding of what we call corporate disclosure. And what are the two main types of disclosure that we have? We have mandatory and we have voluntary disclosure. So, what are the required characteristics guiding effective corporate governance in any organization? Because these characteristics cut across, please. It can unmute, please. So, what are the characteristics guiding effective governance of directors and responsibility? One, probity. Two, commitment. The third one is accountability. Four, equity. Equity is very essential. All directors, the shareholders, all the stakeholders, the non-executive directors and what have you, including the support staff, they must be treated with equity and justice. Responsibility is another guiding principle and utmost good faith. There must not be anything like insubordination of the director's interest. The interests of the shareholders should supersede that of the directors. So, what are the advantages of performance evaluation and the advantages of working in line with code of corporate governance and the concept of governance? So, if directors work with equity, utmost good faith, integrity, and they show some level of transparency and accountability, the benefit of this are this. One, so it will increase the probity and accountability. Two, it will enrich the strategic decision making. Three, it will attract new investors because the investors are watching, they are observing the activities in that company. Some of these unknown investors, they are stakeholders that monitor the activities of the company. The performance of the company affects them, influence their decisions. So when a company is doing very well, they are being attracted, and there's a drive for them to invest their money. So it boosts shareholders' confidence and help in mitigating. It assists in offsetting and cushioning against business risks. So what are the disadvantages of this? Let's increase the speed. One, it limits strategic flexibility because we have to adhere rigidly to the provision of the law. So that's why the strategic flexibility is reduced. So it puts constraint to implementation of new changes. But all these new changes have to be deliberated. It has to be approved. And there might be a sort of bureaucratic decision making and approval. This takes a long time. So having looked at that, we have some specific code of corporate governance in Nigeria. So some of the specific code of corporate governance in Nigeria are for banking. We have the Central Bank of Nigeria Code of Corporate Governance Code. For insurance, we have National Insurance Commission, NICON Code. For pension, we have National Pension Commission, that is PENCOM Code. Next, we have the relevant laws and regulations. So the three bodies that are saddled with regulations of all these code are the Nigerian Stock Exchange, particularly for all listed companies, Nigerian Stock Exchange, the Financial Reporting Council of Nigeria, and Nigerian Stock and Central Bank of Nigeria, CBN. The third one is CBN. Sorry about that. Nigerian Stock Exchange was repeated twice. The third one is CBN. So the implementation of performance evaluation, the implementation of performance evaluation require the following. One, regular training and manpower development, external consultant, benchmarking, peer review, and 360-degree appraisal. So that 360-degree appraisal is more or less an open appraisal. It can be friendly and be hostile at times, in which the executive, non-executive director, the strategic capers, the top management and the lower management they are being assessed openly. So each individual will know their strengths and weaknesses, and a sort of feedback on how to improve this area of relative weaknesses and the support the management can give them to be done. That is 360 appraisal. So another way of establishing or implementing performance appraisal is through appointment of performance evaluation committee. All this committee will be saddled with the responsibility of the evaluation and reporting and giving feedback. And nothing can be achieved without that number 5. We have to establish the performance evaluation criteria. What are the criteria that we want to use to measure or evaluate all this performance? So, like I told you, that there are 3 bodies that are pioneer the development of corporate governance in Nigeria. I mentioned that some seconds ago, that the 3 bodies that pioneer is the Central Bank of Nigeria, which serve as the apex bank in Nigeria. They are saddled with responsibility of identifying areas of relative shortcomings of corporate entity. And their performance evaluation role is not limited to the banking industry. So the Company and Allied Commission 2, they assist in monitoring of corporate governance for public compliance and to protect the interests of the shareholders and to minimize their losses. So the CAC perform this role in order to promote accountability, transparency, disclosure, and oversight functions. The SEC. The SEC regulates and develops capital markets, and they ensure strict compliance to Code of Corporate Governance, particularly the rule-based approach that we have discussed. So the exams can be funny at times. They can just ask us the reasons for performance evaluation of directors, what are the provisions or criteria for evaluating this performance. So what does the Nigerian Code of Corporate Governance says as regard to the performance evaluation of directors? And at times, instead of using the word Nigeria, they can go to the extent of asking you what does the Code of Performance Evaluation of the United Kingdom or American States. But the UK Corporate Governance Code on Performance Evaluation was stated in the syllabus. So the very reason why I put the UK there, because we have International Financial Reporting Code, we have International Corporate Governance Performance Evaluation. So what was the provision of the UK Corporate Governance Code in relation to performance evaluation? So what the code states is that one, the UK provisions of Code of Performance Evaluation states that number one, sorry about that. It says that one, there should be a formal and rigorous annual evaluation of the performance of the board, the committees, the chairman, and individual directors. Two, the chairman of the board should act on the results of the evaluation. Three, where appropriate, based on the evaluation, the chairman is empowered to propose that new members should be appointed to the board or should seek resignation of one or more directors. So that is the areas where we have a critical cases whereby the report of the evaluation shows that part of the committee or some directors, they lack the requisite knowledge, the expertise, or some of them have long overstayed in that position. They either need to be replaced or retired. So we have looked at the assessment performance. This has been looked at. So I've summarized this at the beginning of our lecture that the assessment performance. So the essence of the assessment performance is to ask some questions that are the board performing their objective, their assigned tasks in line with the provision of the law? Are they relating, giving feedback, and engaging the shareholders? What are the contribution of the board to risk management? So all these things have informed you up to this that we have as number 4. That is the composition of the board and its committee suitable. And all these board of committees, they must be predominantly NED, non-executive directors. So we are going to have a sort of revision by the time we cover the syllabus, and then I will introduce some past questions. Those past questions, we see how these questions are being asked. I've been gathering some selected diets and questions that we are going to solve together. So it will give us a sort of X-ray outlook of how I can ask all these questions and the technicality in it and your approaches to all these questions. Okay, let's proceed because of time. Then we move to the need for board committee. The need for board committee. So a board committee is a committee that is set up by the board of directors consisting of selected directors that are given monitoring responsibility and the performance of some management functions. This committee, they are advised, and their roles in different companies are not the same because we have some areas of disparity based on the size and the policy of the company. But any appointed committee, be it a nomination committee, remuneration committee, audit committee, they don't have the power to make certain decisions. but their major aspect is to act within the capacity of their given responsibility, and they are expected to report back to the board. They must give a comprehensive report, and after their report, they must make recommendations to the board. Those are the basic functions of most of these committees. So what are the main committees of the board? The main board committee comprises of the following. We have one, the audit committee. You all know that the audit committee are very, very essential in any organization. And this audit committee, they perform a lot of roles to assist the company in minimizing fraudulent activities in the organization. The audit committee liaises with external auditors, because most companies, for transparency in governance, the activities of the external auditors are being engaged. They must liaise with them. All their findings and recommendations must be attended to, and this must be communicated to the shareholders. The audit committee equally play a risk function. They identify risks, recommend way of mitigating against the risks. They identify areas of non-compliance and give constant reporting. So the audit committee must play a neutral role, and there must be a declaration of interest. I'll give you a short note on Saturday morning, when you have 8 to 10. I will utilize that time. That on Sunday too we're having lectures Saturday and Sunday. So I can develop some few notes for you on the audit committee and remuneration committee and the demerits of the audit committee. Okay, two, we have remuneration committee. Their responsibility is to consider and negotiate the remuneration of the executive directors and senior managers. And this at times is not done in absentia, particularly when the directors is newly appointed. So they can interrogate the directors, they discuss to know the appropriate remuneration that is equivalent to the market value. So their responsibility equally cover determination of all other incentives, reward that the directors will collect, including bonuses. So this one will boost their morale, create a drive for them to give 100% commitment and achieve results. So the remuneration committee should be fair and equitable in determination of remuneration package for the executive directors and senior managers. And they should make provision for board of directors pension policy. So the nomination committee, their own responsibility is to identify and recommend individual for appointment. That's on complaints. That was one ICAN that was said some years back. In that complaint, the family that owns that company still retain 40% of the shares, while the remaining 60% of that share was owned by outsider. But where I'm going is that you now discover that all major directorship position, senior management position are being owned by this family. To the extent that the present chairman of the company, who is about to retire in the next 2 years, is paving a way strategically for his junior brother to succeed him. All these things are not in the best interest of the company. And those are the things that the nomination committee try to identify and correct. So the risk management committee too, they have their own duties and responsibilities to perform. So what are the reasons for us to have a board committee? Reason for having a board committee. The essence of the board committee is to increase the efficiency of the board member. 2, to improve corporate governance, performance, and results. The essence of the board committee is to minimize the rate of business risks and prevent the sudden collapse. And some of these board committee are being established for check and balances for the non-executive directors to checkmate the activities of the executive directors and for them to act as a whistleblower. So having a board committee is advantageous to the organization because it will enrich the decision making, it will bring about board balance, board diversity, and to prevent the situation whereby power will be concentrated in certain directors or individual in the organization. Shareholders activism. What do we call shareholders activism? Shareholders activism simply means the reactions of individual or group of shareholders to some vices, poor corporate governance, and activities of the directors. Shareholders activism normally occur when the shareholders are dissatisfied with the performance of the company's director, when they are experiencing discomfort in the way and manner the company is being run or managed. So shareholders activism occur. So mostly at the AGM, all these issues are raised, particularly under AOB. So through shareholders activism, if there is no positive improvement and all these ugly scenario is being repeated, what happens? See, some of the shareholders, he can sell his shares and cease to be a member of the owners of the company. Some shareholders go to that extent. Because things are not done here. There is no ideal environment for investments. That all the directors are not doing what is expected. And yet, the shareholders do not have the power to control them. Maybe through voting or removal or appointment of another directors. So they can decide to sell their shares and discontinue with the company. Because it's of no use continue to invest in a company where the directors betray your trust and confidence. So due to that, the shareholders normally exhibit what we call activism. So apart from selling one share, the alternative approach to selling shares in underperforming company is to do the following. 1, monitor the company's activities and that of the directors closely. 2, enter into dialogue with a company when it is underperforming and express the concern that the shareholders have about the company. Like I told you, 3, the shareholders have the option of using their voting rights, voting power, to put pressure on the company management. They can use that voting power to remove them. So shareholders activism occur when the company is not run properly in the interest of the shareholders. It occurs when the shareholders are not getting feedback, when the shareholders are not properly engaged. It occurs when the company is experiencing a ton of poor performance or negative returns. So what are the purpose of shareholders' activism. The purpose of shareholders' activism is to try to improve the performance of the company. That is the major purpose, to take a redress and to ensure that the declining performance of the company is improved. So what are the nature of shareholders' activism? The nature of shareholders' activism, we have mentioned some of them, comprise of the following. One, shareholders should monitor the company in which they invest. That is one nature. Two, shareholders association. You can have a lot of association whereby they share experience, information. Anytime there is a crisis like that, so they can work collectively towards amending and overcoming all the challenges. And three, there should be a standing policy that will indicate at what point should the shareholders intervene in a company matter by expressing their concern, particularly when there's a matter of urgency. We don't have to wait till AGM meeting. We can quickly address that point, maybe probably through EGM, extraordinary emergency general meeting. So those issues can be addressed there. So we have the general meeting of all the companies and the voting by shareholders. So that one, we all knew that all companies stipulated by law normally have what we call the annual general meeting, where there's going to be a proper disclosure and reporting of activities of the company for the year ended. And at that time too, the shareholders make a lot of ratification on some decisions and policy on dividends, removal or appointment of new directors, resignation of directors and what have you. And then it will give an opportunity for them to have a history of all the activities of the company and the financial performance for the year. So it's a routine thing that companies do yearly. But when it's come to EGM, that is extraordinary general meeting. These are meetings that the shareholders call for emergency purpose or for some specific issues that threat the continuous existence of the company. So when that issue occur, like it might be a major drastic changes in government policy, or it might be as a result of whistleblower information that they want to act on it urgently to prevent the sudden collapse or premature death of the company. So EGM meeting, extraordinary general meeting, can be called upon. So what are the voting rights of the shareholders? The voting rights of the shareholders can be exercised in the following ways. Can be exercised in the election or re-election of directors. They have the right to elect, the right to vote against the re-election of certain directors, particularly when they are using retirement by rotation. So the voting right can be exercised for the appointment or reappointment of the company auditors for another year. So the voting right can be exercised for the approval of dividends proposed by the directors. I just mentioned that during the AGM, the director of the company will present the proposed new dividends of the company, and that will be subject to the ratification by the shareholders. They have the right to accept or reject it. Okay, we have discussed the shareholders' activism. We have discussed it. But that notwithstanding, since we have it here, let me just tell you the meaning of that heading: shareholders' activism and the voting rights. What that one means is that, in principle, the shareholders can use their vote against the board of directors when they have concern about the company and they are not satisfied. They are not satisfied with the response from the board of directors. So how can they achieve their activism, complaints, discomfort? They can achieve it through this. Shareholders might therefore vote against re-election because they are not happy about the running of the company. That is where the voting rights come. So they vote against the re-election of some of the directors. They vote against the proposal to approve the director's remuneration report or the new remuneration report of the company, possible increase in bonus and what have you. They can vote against it that no, this will not come to stay. We are not going to agree on this new proposed increase in remuneration, bonus, incentives, and share options. So anytime there's a shareholders activism, experts advise that instead of you to stretch yourself beyond the tolerance level, all the individual shareholders can form a committee or association or romance mind together to try to vote against the board of directors at a general meeting. So this one will attract press comments and adverse opinion from investors. But it is better because if you and I, because of that annoyance, the way the company is being run, we now sell our shares, who will remain? And all these directors, majority of them are best of passage. By the time they run the company, and some of us left in annoyance, they still go to elsewhere to go and submit CV. So that is what we call the shareholders activism. So with that, we are done with today's brief lecture. So please note by Saturday, we are going to have a comprehensive 2 hours lecture, 8 to 10, by God's grace. And inshallah, on Sunday too, we are going to start our lecture by 1, I pray so, 1 to 3, so that we have 2 hours too. So all other minor areas in the shareholders are in the area of corporate governance. We just look at those minor areas. So we have something like a board structure. The retirement by rotation that I mentioned the other time is a topic, subtopic on its own. So all those minor things that we have now, I'm going to make it in a bullet form. So that one will save our time. So I will just expatiate on all these bullet points. So we have uh, board composition, board balance, board diversity. All these things cannot be more than 5 or 6 bullet points. So board diversity, we look at it. Removal of directors, the role of the chairman, we look at that for, and the role and function of the net, and the reason why the net, non-executive directors, are not giving incentives. Because all these subtopics or any thing that I can mention there, it is our tradition and culture in equity. We look at it, we discuss it with the students. Nothing must be overlooked or ignored because you never can tell what should be the area of interest or focus. At times there are some words that they can just put, like that shareholders activism now. You can just see it as a line statement that at times the board exercise shareholders activism or the students are required to have understanding of the meaning of shareholders activism. So all these things, we have the responsibility of ensuring that we inform you, we let you know, we add more to the frontier of knowledge and your horizon. And that's the only way we can achieve results. That's the only way we can say thank you to you for choosing equity as your choice center. So what I will now advise now is that, please, we have to ensure that we start reading now. The exam is fast approaching. It's fast approaching. Exam is May. March is as good as gone. We got spare our life because in April now we have just 4 weekends there, and our exam is closer. Start reading now. Be it you are doing 1 course, 2 courses, 3 or 4. The time is now. So I pray God will give you spirit of knowledge and crown your effort with success. So God bless you.